Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX strategy at NatWest, and today we're going to talk about Canada and the Canadian dollar. We just had an election in Canada, and that election result has significant implications, not just for the currency, but also for the Canadian economy at a moment when it faces significant uncertainty from trade policy with its closest neighbor, the U.S. And to do that, I'm very happy to be joined by Ian Vanderhorn, who works in our U.S. office covering FX and Treasury markets. Ian, thanks very much for joining.
Yeah, thank you so much for having me, Brian. Looking forward to the chat.
So I want to start let's start right in with the Canadian election that happened on Monday. What was the result there, and how did it compare to the government that prevailed before this snap election was called?
Yeah, sure. So Mark Carney, existing Prime Minister of Canada, he retained his seat as Canadian Prime Minister in this election. And he won, but he did so with a minority government. So the Liberal Party that he's leading won 169 seats in Parliament, which is just short of the 172 needed for the majority. So Liberal parties are no stranger to running the Canadian government with a minority. They've done so in the last Parliament as well. But they did underperform their polling heading into the election. They were expected to win an outright majority in Parliament. I think odds of that were about 75%. So what this means is it's going to require them to work with some of the smaller parties in Parliament. Again, this would be the New Democratic Party, the NDP, the Bloc Québécois, the BQ, and there's the Green Party as well. But since you asked about makeup of the results, I will just note that the makeup of this newer parliament is a little bit different in that the smaller parties have actually conceded a lot of their own seats. So now we're looking at a parliament which has a minority of Liberals, a minority of Conservatives, which is the primary opposition, but you have a much smaller contingency of minority parties as well. The remaining three minority parties actually only have about 30 seats of the 343 total. So the Liberals will be required to work with these parties to pass legislation and get it through Parliament. But it's really just a system that has now shifted slightly more towards two major parties with only about 30 remaining seats.
So I think it's important, as you mentioned, that it sounds like this is continuity more than any major change, because a Liberal government running with a minority requiring the support of smaller parties was where we were before the election, and it sounds like it's where we are now, albeit with the seats shuffled a bit, with the smaller parties being a bit smaller and the two largest parties, the Liberal and Conservative Party, being quite a bit larger. So I did want to ask you about fiscal policy and trade here. What are some of the implications here from this result? I think this was, as you mentioned, Liberal Party being the largest party was in line with the consensus and the most likely outcome. But what do you think this means for foreign policy and for fiscal policy? Because we are at a very critical moment here. Do you think Carney won a mandate to maybe push those negotiations with Trump?
Yeah, no, I think that's actually a very good point, because the Liberal Party platform, and Carney especially, was running on this platform of navigating what was really billed to be a U.S. trade crisis. So this is actually how the Liberal Party gained support into the election, is that Carney took over leading the Liberal Party from Trudeau. And Carney is an ex-central banker. He was governor of the BOC during 2008. He was governor of the BOE during Brexit. So he really came into play, billing himself as the right person to navigate this trade crisis and to shore up the Canadian economy and to defend it from Trump, especially. So when we're talking fiscal, Carney's platform was run off of lower taxes. It was run off of supporting industries and sectors that would be impacted by the tariffs. And it was also run on supporting home building, which is a real sticking point for the Canadian economy. So to your point about the mandate, I think you're right. I think the election shows that Carney and the Liberal Party were handed this mandate to essentially defend the Canadian economy from a potential trade war and to use stimulus to do so. And indeed, on the fiscal side, the Liberal Party's own estimates show that it will expand the deficit in the coming years, although they hope to bring it down going forward. I will also note one thing, and I think you sort of alluded to it a little bit, but a key difference in the Liberal campaign versus the Conservatives was that they were really making countering Trump and the tariffs a real cornerstone of that campaign. So they were talking a little bit tougher when it came to Trump through the campaign period than, say, the Conservative Party. So with the win, they also have the mandate to continue that talk tough rhetoric. And actually, it's interesting because, in my view, that stands as a little bit of a risk for the Canadian economy. You know, you have this new leader who is elected to talk tough on tariffs, and if he does so, it could stand as a little bit of a risk to the Canadian economy, either via call it a slower renegotiation of USMCA or a potential escalation in terms of tariff frictions if you don't concede to Trump what he would like. Those types of things I'm seeing as risks. And while we did see Carney and Trump actually speak already since the election, and they have agreed to meet, I wouldn't necessarily take this as a sign that they're going to come together and quickly get to an agreement. You know, that meeting could take place and the frictions could even be amplified. There's always the potential for that. So that's another risk that we're actually watching. And I guess I'll just make one more point while I'm here. If we can take one thing away that is a net positive, it's that regardless of the election result, there is this continuity of the Liberal Party in negotiating with Trump. Carney will pick his new cabinet, but it's likely that some of the key players will remain. And it's just a benefit to have that sort of continuity and really to reassemble Parliament, which has not, met since before Christmas, really. So that'll be a benefit just to have the Canadian government working again.
Yeah, I think that's important as well. I think that's a really good point at the end to highlight that regardless of how the election result went, it's important for markets to have some semblance of stability here. And now at least the market knows which government won the mandate to negotiate with the Trump administration. So even if there was even if there was progress behind the scenes, it's possible that both sides knew that there was a potential change in government in Canada on the immediate horizon. That didn't happen. And even if it had, now we know the permanent individuals are in the seats to really sort of move these negotiations. But like you said, these are still going to be, I think, difficult talks. I think that's an important point. So let's talk about Canadian dollar here because, amid broad dollar weakness, the Canadian dollar is actually trading close to its year-to-date highs against the dollar. How are you thinking about the election? Well, first, maybe how did the Canadian dollar react to the election results? And how are you thinking about the Canadian dollar here, incorporating not just this, but also broader trade talks and some of its other traditional drivers?
Yeah, I'll start with how it reacted to the results, which was very limited. It was actually a very muted response, less than 0.5% range as the results were coming out. And, I think that really speaks to the level that domestic politics is as a driver for the Canadian dollar right now, which, as I said, is limited when you're considering the other macro factors, such as trade, tariffs, and the U.S. economy are considered. And you also rightly pointed out that the Canadian dollar is trading at a year-to-date high against the U.S. dollar. But I think that's more a factor of just the U.S. dollar situation as a whole, and also the passage of these, call it worst-case tariff risks, if you will. And, that's fair. We're not really compelled to push back against strength in Canadian dollar at this point, especially as we've seen some of the Trump tariff rhetoric sort of back off and downshift a little bit and move in the right direction. But, we do see risks when it comes to the Canadian dollar, particularly since these broader macro factors have more or less decoupled the currency with some of its more traditional drivers, call it equities, oil especially, other of these more risk drivers. If we see those sort of recouple as a next step to start sort of this tariff downshift, that could push the Canadian dollar weaker in our view. I think we also have to think about the BOC a little bit here too. Even though the next meeting is a ways out, we'll have plenty of data before then. We did receive the minutes this week, and in my view, those were on the dovish side. I think those more or less confirm that we're due for another interest rate cut by the BOC in June. So it could be another potential headwind if and when that is realized. So in summary, I guess I'll sort of summarize by saying we're not ready to push back against Canadian dollar strength, particularly against the US dollar here, but we do see these risks sort of looming over that could potentially present some headwinds going forward.
Yeah, it's interesting you say that just because the dollar versus Canadian dollar, the US dollar, this isn't the only currency where we're seeing some of these breakdowns in correlations, whether it be with traditional drivers like relative interest rates or with risk. And so, I think it's right to be thinking about it from the perspective of these correlations have broken. But, if those correlations stay broken, then that's not something necessarily to lean against. But we need to be mindful of how the Canadian dollar is performing relative to some of those critical drivers.
Yeah, no, I think you're absolutely right. We have a little bit of time here, so I guess I'll use the opportunity, Ryan, to flip the script a little bit. We did have a Bank of Japan meeting, and I know the results were a little bit in line with your expectations. So I'm just wondering if you could share a little bit about that meeting. What does it mean for yen going forward, and any of your additional thoughts as well? I'd be interested in hearing.
Yeah, absolutely. And, for those who are frequent listeners to the podcast, last week in this space, we talked about how we thought the Bank of Japan was going to lower its forecast for growth and inflation, and the market would interpret that dovishly, that it would be the Bank of Japan effectively saying we're less confident in our ability to reach the inflation target in a sustainable way, and that has important implications for the timing and scope of interest rate hikes, particularly off of very, very bullish yen positioning, which I think is in part a reflection of what's going on with the big dollar. All of that came to fruition, and we have seen the yen weaken through the decision. But even compared to my own expectation, I do think the Bank of Japan was a bit dovish at this meeting. The downward revisions to inflation forecasts were pretty substantial. One of the notable revisions was that the forecast revision for 2026 for inflation, fiscal year 2026, actually pushed inflation below the 2% level, core inflation, I should say, below the 2% level, which is the effective inflation target in Japan. And so the Bank of Japan effectively saying with its forecasts that its baseline is no longer that core inflation will be at 2% at the end of fiscal year 2026. And so throughout the press conference, Governor Ueda was also very cautious, highlighting uncertainty from trade policy and highlighting how uncertainty from trade policy is not just a factor of trade differences with the US and Japan, but how changes in trade policy have important implications for external growth. And that has broad implications for things like corporate profits and corporate corporate confidence. And you see that in the US, you see it in all economies, essentially, that businesses, consumers, politicians are all incorporating these trade risks. And one of the potential implications there is weaker corporate confidence. And one of the potential feed throughs for Japan specifically is if corporations are less confident and profit margins are hurt by the trade war, maybe that means they're less confident to increase wages, which is maybe the main source of domestic inflation that the Bank of Japan has so closely been watching. And it's been driving their more hawkish stance that prevailed before the trade war uncertainty came through. So taking that all together, it's not to say that the Bank of Japan is completely off in terms of resuming normalization, hiking the interest rate. I don't think that story is completely behind us. But I think what the Bank of Japan effectively said was we're in a period of uncertainty, and it seems likely that they're going to need at least a resolution of trade tensions, either whether it be a short-term deal or more confidence in the direction of travel, before more meaningfully taking that step towards normalizing further. And so this is a domestic driver of the currency that certainly moved a little bit in the weaker direction recently. Against the backdrop of very bullish positioning, I think it's right that we've seen some paring back of yen outperformance that had prevailed for the last couple of months here. But of course, there's two sides to the dollar yen coin, and there is the big dollar side as well. And I feel like that is still going to be the driving factor of this pair. Now, we're recording on Thursday. We'll see what non-farm payrolls has to say tomorrow. But we do think that there are downside risks to upcoming U.S. economic data that could challenge dollar exceptionalism further. And if that happens, we could see the yen rebound here. But the domestic positive for yen that was coming from a Bank of Japan that was quite hawkish earlier this year has certainly taken a step in the more dovish direction, and that's contributed to some weakness in in the yen that we've seen over the last couple of sessions. So, Ian, thank you very much for joining. On that note, let's close it out here. And to our listeners, thanks very much for listening. If you enjoyed the podcast, please consider giving it a like and also subscribing to our channel so that you get our latest content the moment it's released. Thank you very much.